button. You like it at the record button. Right. Hello, everybody. This is the Thymble podcast. I'm Ben.
And this is Tyler.
And this is a podcast about personal finance. We're coming at you with tips and advice on how to start your journey into investing as a young man, young woman, whatever. I'm assuming mostly going to be young men, but hey, we're open to everybody. To this first episode, what we're going to talk about the mindset that you want to have going into finance. As a foreign idea for most people, a lot of people aren't thinking about, putting money away for the future. If anything, you know a little bit about how to save money based on being in school, based on, things like that. But we're going to dive into some of the reasons why you should be thinking about investing now to set up a better future. So first thing I want to talk about, Tyler, is, personally, why are you interested in investing and finance? Obviously, you're educated in finance, but from a personal standpoint, what makes you want to invest?
Personally, I break it down into the short and the long-term goals for myself. I see these long-term horizons that I eventually want to reach later in my life, and those short-term goals such as, everyday things like groceries, paying for the gas bill, maybe fun hobbies as well. And so I think of it in that perspective, how much can I save, maybe put toward 401k for the long term, and how much can I, use as expendable dollars today in the real world? Yeah,
sure. So I think that's the big thing. I think what we are in the habit of doing just as people and as just humans is that we only think in the short term, and thinking in the long term is just doesn't even come to mind. And
exactly.
Especially when we're talking about putting away something that the long term is years upon years, and not just, for some of us 6 months is a long time. But when we're talking about investing, we're going to be talking about longer than 6 months for the most part. So, other than that, so what is your personal, I think one of the most important things you have to establish when you're getting into finance, when you're getting into investing, is you have to establish, how does my personality fit with how I view investing? So personally, I think about risk versus risk averse. How risk averse am I, or how risky am I? And, personally, I am not a super risky person when it comes to, especially my money. But I'm also not incredibly risk averse. So I feel like I'm somewhere in the middle. And that's going to guide my investing strategies moving forward. Tyler, what would you say? Are you more of a risky person or a risk averse person?
I couple that and say, I always like a little bit of that higher end risk to maybe get some more reward. Because I'm young right now, I see that broad horizon for the future. There's always potential for more upturn than you're seeing in the stock market if you're just tracking an index. So maybe be a little bit more risky with, say 20% of your portfolio. And then hold up, stop.
Just speak of your personal experience. Like think about when you didn't know anything about finance.
Yes.
Think about how did you go into it? What was your mindset? Because that's who we're speaking to. We're speaking to people who are just getting into this.
Ultimately, yeah. So it's that whole idea of, making money. And so I wanted to, you always hear of these, fantastic people out there, being able to hit it off, or starting from the ground up, having invested in a very safe company or a very safe asset they just felt was very good for them, but also maybe had a little bit of that higher risk, higher return. And that's how I always saw it, once I was in the high school age. But once I got more the college age, I was like, maybe I can balance some of that, or essentially hedge that with safer risks ideas and things like, bonds, things like, tracking indexes, to ensure that I have more stable grounds for my investment, to ensure that I do have some money going forward. Because what if those higher risk, higher end investments actually go south? Well, then I'm going to lose a good bit of my money, and so I want to ensure I balance the two in what I call hedging.
So I think what I find the most interesting about what you said is that you had that shift in perspective. Mm-hmm. And I think at our age and at our time in our lives, where we are in our lives, is that shift is super important. Mm-hmm. Is understanding, when you're young, when you think of investments, a lot of times you think of the big money investments where someone bought early in a good company and it just happened to blow up. But I think when you get older and when you start looking into finance and you start studying it, you realize that kind of stuff is 1 in a million. Exactly. That kind of stuff is not something that happens every day, and it doesn't happen to 99.9% of us. So I think, speaking to people our age, that's what we need to focus on, is focusing on shifting our mindset into saying, I'm not going to get rich quick.
Exactly.
It's not a reality. There's all those people out there who sell you dreams, who sell you, hey, look at my car. You got me in my garage with my Lamborghini, and all I did was I just invested in stuff, and now I'm here. And that's not the reality of what most of us are going to be. 99.9% of us are not going to get there. But that's not to say that investing isn't worth your time. It's not to say that by not investing, you aren't missing out on improving your life in a substantial way.
Exactly.
I think of my own long-term goals. I don't want to be worried about money. I think that's where I think a lot of us want to be, is we don't want to be worried about money.
Especially now at this age. I mean, when you're thinking about it, maybe you were investing some of what your parents gave you, say $100, and they're saying, go have fun with wherever you want to put that and see how that turns out for you. But especially once it becomes, you're getting your first job, you're starting your first salary. Nice, have the phone go.
Yeah.
Getting your first salary there, it's like, how can I include that stable income to go further into my life, and how can I maybe take a little bit more responsibility with the money to still have, those good outcomes that we're looking for in the future.
And I think, as college students, as younger people, we don't like to think about not being able to spend our money. We want to be able to go out, and I like to have fun. I like to go out, and I do spend money, but at the same time, there are ways where you can budget your money appropriately, and you can still have that money to go out and have fun and do the cool stuff you want to do in your life, while also making sure that you do have that future being planned for. So one thing, I'm just going to pull up my notes. So I also want to talk about then, so we kind of talked about the mindset. We've talked about the shifting. We're not going to get rich quick. You got to have the time commitment. But I want to talk about where do we really get started? How do we really get started? I know a lot of people that I know who are our age that already have portfolios or already have assets. That's not stuff that they worked at McDonald's and then saved their money and put it into. That's their mom and dad gave them money, or they invested for them. And I don't think that's the majority of us are not coming from a situation where that is a reality. Now, there's nothing wrong with someone's parents, giving them that kind of setup, giving them a good start. But I think we want to make sure that our audience is able to
has that opportunity.
Absolutely, regardless of their background. How can they get started? So the first thing that comes to my mind is you have to work. You have to. I know that it almost sounds too obvious. But you have to work and you have to save first.
Because you have to work to save.
You have to work to save. You have to make sure that as you're working, you aren't just pissing away all of your money on random stuff, that you are budgeting. So that is the first step to investing. You're not going to fall into money. You're not going to be able to put $1 into some stock that grows up. We've kind of already mentioned that. But everybody wishes they would have invested in Apple when it was a nobody. But that's just not going to happen for the most of us. So by working and saving up, that's how you get your foot in the door of investing. Todd, do you know, what's your idea of how much money would you say is the right amount to start investing?
So comparable, I would say percentage of wage or percentage of salary. The way I always see it is, even if there's not the 401k options, or even if you're not considering things like an IRA or et cetera, I'm always thinking to myself, maybe even starting an Excel spreadsheet, maybe that's a good place to start. And seeing the costs that are in my everyday life, paying for the gas bill, paying for the energy bill, paying for, wear and tear in my car, paying for the groceries, paying for classes at school, or, having drinks with friends. I just actually forgot what I was going to say. He looks like he has a stick up his butt. Yeah, I personally can't take it. Just kind of.
So back to that question. The question was,
no.
What amount of money do you think is the right amount of money?
Yeah, so when you're looking at that cost allocations and seeing where your money's really going to in the long run, you're thinking to yourself, how much more expendable dollars do I have after I've paid for all the normal costs in my life? And how much of that do I maybe want to put toward extra hobbies that aren't necessities? And how much of that do I actually want to save for the long term to maybe break into some of these things that I'm looking for my long-term goals. And so I would always say is just a normal breakdown is maybe, if you can, save at least 10% if you can. And if you really have that expendable money or those dollars left over and you want to have those long-term horizons, you have those goals for the future, I would say maybe even up to 20% if you can, starting off. And for a lot of people, that's very difficult because of, beginning wages, beginning salaries. I understand that completely because I'm in that boat. And so it's just a consideration of, is there ways I can cut down on the cost to maybe bump it up to maybe 15% goes into savings? Or is there ways I can just reallocate how I plan my own life for that? And so I'd say the good basis is a 10 to 20% for savings and about 80% for your everyday life necessities. So,
okay, yeah, I think that's definitely something that I can agree with in a lot of ways. I think the percentage approach is, it's easy to follow, really, if you stick yourself to it, if you discipline yourself. And, it's not that hard to say, okay, I have, I only make, let's say you make $30,000 a year, doing part-time or maybe doing a full-time job. It's not that difficult to just say, okay, well, 10% of my monthly wage, I'm just going to put it into an account, put it into a savings account at first. You don't have to immediately start dumping it into some investment, especially, a lot of times, if you're working part-time, if you're working multiple jobs, you're not going to be able to be investing. Your company's not going to handle a 401k for you, right? So that's not something that is going to be handled for you. So you have to make sure that as long as you're saving the money and understanding that money is not to be touched, you can figure out how you want to invest that later. But the first step is just making sure that you have the discipline. It really comes down to discipline.
Almost make it a necessity to save, and then you have your expendable dollars after that.
It has to be, you have to think of your investment money as the equivalent of your food money. Like, you have to have money for food, so that is money that you don't spend on video games. Or that is not money that you spend on bullshit, like, the strip club or something, Like, you spend it on things, or the money, you treat it like you spend it on food money. And in that way, if you can get your mindset like that, it makes it so much easier to be disciplined. I think that is something we all struggle with, is disciplining ourselves. And so this is a really good area to practice being disciplined, because it really doesn't require, it's easier than disciplining yourself to go to the gym. Because going to the gym, you have to get off your ass. If you're setting aside 10%, you literally just have to put the money into an account and call it investment.
So just think, what if you didn't have that job down the road? What if you're not having that salary, that income, that wage down the road? This is where that savings comes into play, because what if you still need those groceries and other necessities down the road? Do you have the income to support that, or did you spend it all prior to your interest, your hobbies?
Yeah, absolutely. So this is money that is for investment, but like you mentioned, we don't always know where our lives are going to go. So worst case scenario, that money that you were going to invest becomes an emergency fund. So there's no downside to setting up that account, besides you might have to sacrifice some, a coffee from Starbucks or a burger.
Especially if you're one of those people that do that day in and day out. Think of that. It's $5 you could be saving each and every day times $300. Look at that. That's already $1,500 that you could have had into your savings. And grow that over time. You could be looking at $5,000 in a few years.
Yeah, and I don't want to turn this into a how to save money podcast, but I just want to make it evident and clear and emphasize how important it is to save money in order to invest. I like to think of, as far as, I think the percentage approach is really great. I like to think of, depending on what investment you're going into, you also might, parse out your money differently. I've talked to some people I respect who are, regular investors, and
so you respect them.
Yeah, exactly. Yeah.
Wouldn't even dream of touching it.
So I've talked to some people that I highly respect who are long-time investors, lifetime investors, and when it comes to, for example, investing in stocks, and we'll go into more detail, at a later date about specifically investing in stocks. But when it comes to investing in stocks, it helps to say, okay, I'm going to invest this much capital, so this much cash, and that cash is going to come from your savings that you set aside that percentage. So I might be saving up until I have $5,000, and this is just an example. It could be $1,000. I would say less than $1,000 is probably. I would just keep saving at that point. Yep. It's not to say that you couldn't
buy that stock.
I mean, it's not to say that you can't, but I would say you're better off just holding off, waiting until you accumulate some more capital and then investing in it. Because
you want to have that strong base to fall
exactly.
back on, if you just put $1,000 out there in a stock that maybe goes south, or a few stocks that go south.
Exactly.
And you didn't have the opportunity to diversify yourself.
It's a lot harder to diversify if you're dealing with $100 versus, and we'll talk about diversification and all that stuff, but definitely I would recommend saving up until you get to a certain goal. Set a goal for yourself as far as how much money you want to save, and then begin to invest.
Exactly. And even when we're talking about that $1,000 into the savings account, there are ways that you can earn high reward for things like that in different investment vehicles before you even get into the stocks and the riskier assets out there that you can earn a little bit more than the banks are currently giving you. And I think that's going to be an interesting topic to discuss further.
Yeah. I want to talk about a little bit about some of the myths behind investing. We've touched on them a little bit when we said, you're not going to get rich quick. But I want to point out some specific examples that I personally, think have a lot of people have fallen for. And so I think one initial myth is that to be an investor, you have to be a day trader. Meaning you have to be the guy who's watching stocks all day, who's paying attention to your prices,
knowing your ins and outs about everything,
knowing everything in the business world, all that stuff. You're not going to be that. You don't have the time, nor do you have the energy, especially because you're not working as an investor on Wall Street.
That's not your job.
You're not your job. So you're not expected to know everything about the investment world. There are professionals out there who can help you. There's shows like this that can help you.
Definitely shows like this.
Definitely shows like this one.
You got more emphasis on that now.
But yeah, I just want to, you don't have to be the expert day trader. You don't have to be 24/7 watching your portfolio all the time. I think another myth, and this one is even more specific, is that I want to talk about cryptocurrency for a minute.
Oh no.
Because I think it's a hot topic, but I also think there's a lot of BS about cryptocurrency.
It's almost buying into ideologies because there's these new things that just hit the market and no one's familiar with them. And even when you go all the way up to Wall Street and it trickles down to Main Street, nobody's really familiar with them.
I mean, even people who understand the ins and outs of blockchain and how blockchain works, and I have a decent understanding of blockchain.
We don't know where it's going to go.
Yeah, exactly. We're not, even people who know, they're not fortune tellers. We don't know what players are going to come into the mix, what kind of regulations are going to be produced. It's such an unknown that to say that, I'm not saying that you can't invest money in cryptocurrency, but I would say
that's not the place you start.
That's not the place you start. And don't expect to, that is, I think, the most recent get-rich-quick scam is like altcoins, which if you're not familiar, it's basically anything that's not a Bitcoin is considered an altcoin. I know a lot of young guys who have put money into these coins, and either they lose money or it's completely stagnant. I know a few people who got very lucky and managed to put $100 in and then sell. But again, that's such a short-term thing. That's the wrong mindset. That is a short-term mindset.
If you want to debunk cryptocurrency a little bit more, it's these ideas that you hear, people have put a little bit of money in there and they've grown so much and then they lost access to the account.
Sure.
Or even more so is hackers can actually drain the account because it's not a securitized asset.
Yeah.
It's an asset that's on the market without, the backing of any bank currently.
Sure.
And so it's that idea that somebody can go in there, drain the account, you lose all your funds because you have to derive, the cryptocurrency from actual dollars. And so you're out money, and you never had that backing from the very beginning.
Absolutely. And if we're talking about people who are young guys or young girls who are trying to start investing, you can't afford to lose for something like that to happen.
So it's the idea of starting small.
Exactly. Starting more risk averse, if anything, and then slowly moving towards when you have the ball rolling, then you can start thinking about things like that. And even then, even when the ball is rolling, I would still caution about cryptocurrency in general, but I'm also not going to completely decry it as saying
if you want to go assets like those, and not to get too into the weeds here with other investments, but there is at one time an interval fund, and what you do is you provide a hedge, or somebody else, X amount of dollars, and when you're talking about hedge funds, millions of dollars, and so somebody would put millions of dollars in, and they lock that money up for at least 3 or 4 years, in which you cannot pull that money out, and that hedge fund is doing exactly whatever they want with it.
Sure.
So again, it's that inability to access your funds, and
sure.
Granted, we're not starting out with that kind of money. No one is,
no.
But nonetheless, it's that idea of, is it securitized? Who are you providing it to? Is it a good means of diversification for you? And are you starting small? Are you really reading into where you're placing your money?
Yeah, it's very important to think about where you're placing your money. I want to also talk about, I want to go into a little bit more detail on the kind of the Millionaire Mentors and things like that. They are selling you a product, and that product is a dream. That obviously these guys are intelligent. They've done some right things.
They're influencers and marketers.
That's primarily what they are. They are not giving you.
That's how they made their money. They're selling you the idea, and that sale for them is their income.
Absolutely. And so, and they've got this kind of self-fulfilling prophecy where they sell you a dream, you buy the dream, regardless of whether you get that. They get more money, so then they continue to grow this brand of, look at me, I'm rich, I'm getting rich through these principles that I'm giving you, even though that you can't actually apply them to your life because they're normally vague or vapid, to be really harsh. But a lot of times they're not realistic to where you're coming from. But as humans, we all love to see
the possibilities.
We love to see the possibilities. And a lot of times we're not practical with ourselves and our own situations. So I just want to, if you're someone who is out there watching these Millionaire Mentors, I would ask you to reevaluate how much of that advice have you really been able to take and apply to your life. And where are you right now?
Make sure you're guaranteeing income and not just going 1 in 1 million. Maybe he got that way, but will you?
Yeah, and because a lot of them, and I don't even think, saying read books is the most general bullshit advice. I love to read. I think reading is important, but reading books is not what makes you money. Yes. It's not what gets you anywhere.
Have input in this?
Hey, shut up, Cameron. No. But I mean, it's just the truth, though. That is a platitude. That means nothing. Your elementary school teacher came up with that. Yet she's getting paid, $35,000 a year. But these Millionaire Mentors have all this capital they're gaining because people want to believe in these dreams. So don't buy into bullshit. Don't buy into dreams. Buy into advice that is applicable to you now, and that is knowledge right now. For fuck's sake.
No swearing. I don't want swearing on the podcast. I don't like swearing.
For fuck's sake, do not buy webinars. Do not buy courses from any of these doofuses, because they're dream products and they are BS. Save your money, and then you can invest that money into something real and tangible. Cameraman agrees. That's a good thing.
Thumbs up from the cameraman.
I also want to talk about. That's like the big myths, or maybe 3 myths. I think we talk about 3 things. That's the big myths that I wanted to talk about. Next thing I kind of want to talk about is what are some ways. And I have some ideas, but what are some ways that someone can practice investing without getting money involved? Or even in the same note, what are some low-cost ways that people can practice investing. Do you have any that you can think of?
If you want to go about, pseudo investing, especially if you're talking about, once you have that $1,000 in the bank saved and you're looking to grow it through things like stocks, bonds, et cetera, all those investment vehicles we'll talk about. It's those pseudo portfolios online. And so you can start with any fake amount of money. Say you want to go in with $1 million and just play with it. Or you want to go in actually more realistically with the amount that you have now and just play with that and see how that works out for a few months. You can start investing and, some of it, depending on the pseudo portfolio you go with, it's very detailed and it breaks down and delineates pretty much every strategy, every investment, every index for you and how that's going to work out. And you'll be able to invest, your dollars just like you normally would and see the return on a fake investment and see how that actually works for you. And then do you feel comfortable with how these are turning out? Have you ridden it out long enough to, go with the cyclical nature of the markets? Are you seeing both upticks and downticks with it?
Yeah.
And how are you, I guess, diversifying that for them?
I know I've been doing some pseudo portfolios, and I think what I found to be the most beneficial and interesting thing from playing with that is it actually teaches you more about your own personality when it comes to investing. When you see, the market has a bad day, you can feel your reaction because you're like, oh shit, I just lost $300. Maybe you started with $10,000. That's what I started with 10,000, and when the market's doing bad, I'm like, oh well, crap. And then you can feel that pain, but you get used to it because then the next day you see that, oh, it's gone up. The market's doing well today.
Exactly.
And so you get used to the idea that you have money in a vessel that it changes, it's shifting, and of course you want to look for that overall growing trend. That's the goal, and there's ways that there's many ways that we'll talk about that you can do that. But I think it's a good way of kind of like dipping your toes in the water, whereas you're not like instantly pulling out, like putting your money in and then you're instantly pulling out because, oh crap, I'm losing money, I better sell now, or whatever. So yeah, I think I'm not going to make any specific recommendations for pseudo portfolios, but if you search on any Google or whatever, you search stock simulator, that's a good way to get started. I mean, of course, that's specific to stocks, but I'm sure there's other simulators out there too for other.
But definitely going with that mindset that the money you're losing in this fake portfolio is real money to you, because that's how we want to see it for the long term.
Take it seriously.
You want to feel comfortable with this and the way that you're going to feel with your, like, if you saw this react with your own funds, how would it be to you?
For me, it's like when I'm doing it, it's almost like my pride is on the line. That makes it feel more real because I'm like, I want my decisions to do well. So that gets me more invested in it, in actually playing the game. Yeah. But even though at the end of the day, I can still tell myself, oh, this isn't actually real money.
Because for me, I love that feeling of being able to gauge where I am with new investments. Because, once you learn all the basics in the finance courses that we were taught here at college, we feel comfortable with stocks. We feel comfortable with bonds. But even for us, there's, investment vehicles that are brand new. So I played around with one. It's extremely technical. It's a triple leveraged inverse gold fund. It's an ETN, electronically traded note. And essentially, it would short the gold commodity 3 times. So you say you put $1 in there and the gold commodity goes down, then essentially you just made $3. But at the same time, if the gold commodity went up $1, then you just lost $3. And playing that, for me, being a somewhat comfortable investor, was extremely different investment vehicles. So for me doing that, I actually had my fear gauge going up because you would have to almost, like we were saying, not to do the earlier session, is not day trade. You don't want to day trade, but this is how you had to trade that commodity, because in a day's time, if you weren't very comfortable with how the swing was in the commodity, but the very next morning when the markets opened again, commodity could be in a completely different direction. You either just lost or gained a ton. And so it's very difficult to gauge a lot of these vehicles, regardless of where you are in your own path. And I think this is a very good tool that we can all use, because, heck, if that was real money on me, I'd be out of luck. And so I was very comfortable being able. These blinds could just stop moving. I was very comfortable being able to, see how these vehicles work, because what I want to adapt that and put that in my portfolio for diversification, or is that something I don't want to include?
Yeah. No, I think you even brought up a very good point about the variety of tools that are out there. And I think you also, by using that example of that very complex form of trading, it goes to show the amount of nuance that you learn through doing.
Yes.
And so by using these tools, you can pick up a lot of strategies based on your own personality as well. Because again, I also want to point out, I don't think I've made this point very strongly yet, is that there is no one way to make money through investing. There is no one way to invest. So you have to find what works best for you and what makes sense to you. What you can't. I think a dangerous thing to do when investing is not understanding what's happening behind the scenes with your money.
Yeah.
If you just throw your money into a mutual fund, but you don't understand the mechanics of a mutual fund, if first of all things could go to hell, and you're just sitting there like, well, I put my money in mutual funds. Why aren't I making money? And you're at a loss, and you're confused, and you're angry.
Yeah.
And I know like people I know who I've talked to about their experience investing, and maybe they weren't super successful investing. That was kind of what they did, was they put money in and they didn't know what they were putting their money into, and then when it didn't work out, they were just mad.
Yeah.
Screw this, screw investing, screw mutual funds. So understanding what's happening, and there's no reason why you can't. Of course, some things are really complex, right? And maybe those are things you might want to avoid. So if you can't understand it, if you feel like it's too above your pay grade, that's okay. Don't invest in that vehicle. But I really think anyone can understand stocks. I really think anyone can understand bonds.
Anyone can understand any of these vehicles. It's just a lot of them are more time consuming than
Sure.
others. And so it's all, again, back to that basics of savings, so the long term and the short term.
Yeah, I agree. So, and there's, on top of like the simulators, and I want to actually, I think talking about some of these things I'm going to mention later on, but there are like smaller amounts of money investment tools that you can use to practice. Like, I'm going to name drop, but we're not advertising. I don't know. Could I name drop applications? I mean,
Do you mean Robinhood?
that's fine, right?
Robinhood?
I was thinking like Robinhood. Yeah.
Yeah, switched to
Robinhood.
Yeah, there we go.
Robinhood,
That's what I
yeah.
meant to say.
Like I know, like even in Tyler's description of the simulator he was using, he mentioned like things like shorting.
And these are terms that might not be familiar,
Yeah.
especially where they weren't to us just a few years ago.
Yeah,
But
exactly. So
it's all about gaining that background.
if you hear something we say that maybe doesn't make sense or you don't fully understand,
It'll make sense soon enough.
yes, we're gonna go into more detail. We are going to go into more detail. We promise. And don't feel like you're stupid or that that you're too dumb to understand. These are just things that you're not taught in. Who teaches you these things besides college? I mean, unless you go to college and take a finance course, who teaches you these things? Not your mom, maybe your mom and dad, if they are, and that's only
if they're in that business.
If they're in that business, or they are,
savvy
investors themselves. Which, the average person, their parents are working class people, or maybe they have some money in savings accounts and things like that. But they might not be the savviest investors. So.
And it's all about, the savvy investors weren't savvy investors at one point. How did they get there?
Yeah.
And so, again, it's not the idea of buying into an ideology that they got there quickly, because they probably didn't.
No.
And so it's how can we do that, safely, securely, and looking for those goals that we're talking about throughout life.
Yes. Yeah. I think that's very true. So, back to, I want to mention some tools, too, that are lower investment strategies that I think we'll probably end up highlighting them even in depth about how the mechanics of them. But things like Robinhood are low capital investments. Like you invest in small stocks and watch them grow and fall. And it's more volatile. It's closer to something you have to pay attention to every day. But it can be fun. I know a lot of my friends do it just for fun. But they also maybe make some money, or maybe they lose some money. But even my friends... I'm just gonna stop. But a lot of my friends who might lose money, they still come back to me and they tell me that they learned a lot.
Yeah. That
they learned a lot about themselves and how they invest, and also how they want to invest. So, using these things that are low cost,
Really, the other one's gonna do it now.
I'll just close the windows.
But especially, I think you hit on a good point there, is personalizing your own assets. And that's one thing we're definitely going to get into, because there's so many vehicles, there's so many opportunities, so many directions out there that, where do we start, where do we begin, and how do we make it truly us? How do we, align that with our own principles of who we are and our own goals as to where we want to eventually be in life? And so I think, biggest thing is there's no one set path to wherever you're looking for, because it's you, and we really need to take a hold of these assets and do our due diligence, understand the background to where we're putting our money, and going forward with that.
Yeah, and the goal of this podcast is to provide you with the tools and knowledge that you can use and then personalize it yourself.
Yeah.
Because we're not going to give you the one strategy. We're going to give you, here's a lot of information, make it so you can understand it, and then apply it to your own life and personalize it. So, I think that's really important. But I think we should tell everybody a little bit about ourselves.
It's a good idea, Ben.
Yeah, so all we did was give you our names.
The cameraman just suggested that.
Yes, thanks, cameraman. But I'm Ben again, but
Ben again. Nice to meet you.
Ben again, thank you. I'm from Ohio. I grew up in a working class family. My father was in the Air Force. My mother was a stay-at-home mom, but also did some work on the side. I grew up just working hard we had a little farm, so I worked up doing chores and earning my money that way through allowance and things like that. And I mean, it wasn't crazy allowances, but I had to work for it either way. And from a pretty early age, I learned to make my own money, and I started working real jobs as soon as I could. I started working at 15, doing some landscaping under the table, but that I think taught me very early on that we need to start saving my money and then figuring out how to use that money. My parents weren't big investors. My father was a big buyer into gold. We'll probably talk about gold at some point in the future, but I wouldn't recommend putting all your money in gold. We'll just throw that out there. But yeah, and so now I'm just going to college, going to school, studying information systems in the business school, but I have been educated in finance. I tutor intro finance, so that should I have a good amount of experience walking people through concepts. And so as we move forward in this podcast, and we will be going into more detail, and we will be taking you by the hand and walking you through step by step some of these concepts in a way that's easy for you to understand, because that's our goal. Our goal is to make sure that you are empowered as an investor and as a person to take some control over your money and understand what's going on.
Yeah.
So you want to tell a little bit about yourself?
You betcha. So born native Pittsburgh, Pennsylvania. Dad was in the auto glass market, and my mom would sort of jump around a number of jobs as they moved around for his job, and eventually became a stay-at-home mom for me once she had me. And extremely thankful for their principles, bringing me up and helping me understand, my whole path of saving. So before, I even understood any of this stuff or even got into finance or numbers or any of that, I knew I wanted to be a hard worker like they were, and I wanted to look up to that and be able to start making my own grounds there. And so, similar to you, started at 16 in the restaurant business, and always liked the idea of being able to, present things to people and always derive like a good customer experience and just have fun doing whatever I was in. Because if you're not having fun, that's the biggest thing. Sure. You want to be having fun doing that and, making your own headway in life with that. And so that kind of brought me to the idea that I love being in front of, what would eventually be clientele. And so having started to develop at that age in high school, a desire for numbers, but also desire, client facing, I found myself following finance into college. And with that, I've worked for 3 different banks and have had, a phenomenal opportunity just understanding how I can apply my principles of saving, my principles of being able to, explain technical mathematics and do that client side, because a lot of people may not be familiar or comfortable with that sort of stuff. And I feel that's sort of where I was able to bridge that gap and come in. And I've truly found my own path in being able to, enjoy life, but at the same time also be able to pursue those long-term goals for myself, those long-term and short-term goals. And so that's where I found myself within life here.
Yeah. And so we might not be millionaires. We might not be incredibly, out of this world successful, college dropouts, who made their money very quickly, but we are on good
Unlike
paths.
Our cameraman who dropped out and has made multi-million dollars.
That's how he's funding this show.
Yeah, that's how he's funding this show.
Though we might not be those, we are on good paths, and I think we are confident that we can give you some real actionable advice and knowledge.
From our own lives.
From our own lives. I mean, from our own experiences. And we're not going to sell you bullshit. That's the big thing, is we're not going to sell you BS.
What have you guys hit so far?
Pretty much just...
the love and the pursuit of happiness.
Yeah, pretty much just a lot of surface level stuff.
Okay.
So a lot of like...
We're up here right now.
Yeah, we're up here. So the very high level, as they say in the business world.
So now, having had the opportunity, tell you guys a little bit about who we are and where we come from, and the whole idea of this podcast, where we want to take it forward. We would love the opportunity again to break things down, and especially in later episodes, we're going to go into all those investment vehicles. We're going to go into that step-by-step breakdown we were talking about as to how to even begin any of this and tread through those murky waters. But I think this is this first episode here is a good overview of what we're going to show you, what there is out there, how we have come to see the markets, and how we think a good way to start investing will be for you. And with that, I think we want to conclude here and then see where we end up forward.
Yeah, I think next episode we're going to dive into stocks, and we're going to take your hand, and we're going to take a nice walk along the stock beach, and it's going to be a great time. We're going to have fun.
From Main Street to Wall Street.
Sure. All right, thank you, everybody.